it could cause some very modest increases in interest rates to get that reallocation. But these are investments our economy needs to be competitive and to be productive.
We're seeing very substantial inflation. It's very interesting. I mean, we're raising prices. People are raising prices to us, and it's being accepted.
Janet Yellen now, the former Fed chairman, fighting, if you will, taking the opposite side from the Treasury now that she's the head of, versus Jay Powell and the Fed. That dynamic, I think, is something that people are a little nervous about, Scott. So again, taxes for corporates and the combination of Yellen going against Jay Powell, because Powell has been steadfast in that they are not thinking about doing anything. And she's saying, yeah, but you might have to now.
But I think her comments are right. I mean, first of all, when you take where rates are today, but particularly where real rates are today that are extremely negative, where we're negative 88 basis points in 10-year real rates. Listen, that's not the right level. You've got an economy that is growing, and it could be well into the high sevens GDP this year. And listen, every client call I'm on, including the one I just finished when you emailed, is talking about overheating. Everybody's talking about overheating. Listen, I think that Fed is right about most of these costs are transitory. And I think most are. When you have a reopening like this, when you have a bid for copper and lumber and energy, you're going to get some extraordinary numbers. And when inventory levels have been drawn down across everything from houses to autos to anything retail. So you get a pop. And I think most of that is a near-term impact. However, the longer that policy stays this easy, as long as the liquidity in the system is excessive, then you run the risk that you overheat, or you run the risk that things, have to, the exit from this policy may have to be a bit more aggressive.
Well, there is some aspect of the fact that May, October is typically weaker than November to April. And there's a buy the rumor, sell the fact aspect to earnings. We know the earnings were great, and the market saw that. That's why it ran up November to April, 27%. But then again, buy the rumor, sell the fact. Yellen's comments didn't help, but the Fed's been skating very close to the edge of the ice. They need to assert at some point that they have independence. And Yellen was sort of lobbing the ball on a lateral to Powell by taking some of the heat by saying what's obvious, which is that eventually, if things really pick up, the Fed has to tighten.
Well, I do think that you're right. She knows what she's saying. And I think she's just trying to give the market some time to digest what is an inevitable rise in rates as the economy continues to heat up. That doesn't mean, however, that that's a rise in rates that's imminent, nor does it mean that it's a rise in rates that's going to get to any level that could totally derail either the economic recovery or, frankly, the stock market. So we think that the market is overreacting to both what will be a slower economic growth rate in the second half, as well as potentially higher interest rates, by assuming that that means we might be looking at something like 1970s era inflation, potentially stagflation, and all of those great worries. We think that growth will be well above trend line, that the Fed will stay relatively easy, and that we're going to see some PE compression, but strong enough earnings growth that will overcome that.